Hey everyone, I'm Professor Stefan. In this video, we're going to continue talking about property, plant, and equipment, so let's get started. So in our first class, we talked about how we acquire long-term assets and what costs get included in the asset value that goes on our balance sheet. And then we talked about interest capitalization for kind of the long-term projects that we build, how we take some of those interest costs on our, borrowing, and we capitalize those actually as one of those costs of construction. And so that gets expensed over time as a part of depreciation. So in this class, we are going to discuss depreciation itself, kind of how do we take these fixed assets and turn them into expenses over time as we use them to generate our revenues. So the whole point of capitalizing a fixed asset and depreciating it is trying to match our costs with our revenues. If we expensed the full value of the asset up front, we would have a high expense when we bought it and no expense later on as that thing generated revenues for us in future years. And so what we're going to try to do is we're going to divide up the cost of that asset and record a little bit of expense each year that it generates revenues for us. And this process is kind of arbitrary. We're going to see in this class that there are multiple ways that we can turn an asset into an expense through depreciation. They all have their strengths and weaknesses, and some might be okay at approximating the fair value of an asset, but that's not really our goal here. Our goal is to expense the asset so that it matches the revenue generation over its lifetime. And so if the asset gets consumed, some piece of equipment, a building, something that wears down over time, we are going to depreciate that over time or expense it over time as depreciation in order to match the kind of expense to our revenues. Now, if our asset does not get consumed over time, for example, a piece of land, which is, expected to maintain its value, assuming we don't do anything weird to it, then we are not going to depreciate that and it'll just stay on our books at cost. So land is never going to get written up, even if the value increases over time. We're going to keep it as an asset on our balance sheet at what we paid whenever we originally bought it. So our goal with depreciation is to kind of allocate these expenses of our long-term fixed assets in a systematic and rational manner. And we're going to use different vocabulary depending on the type of asset. So for PP&E, our expense is going to be depreciation, and we're going to drop the value of our asset when we depreciate it using the accumulated depreciation contra asset account. If we have a natural resource, something like a coal mine or natural gas in the ground that we're trying to frack, something like that, or maybe lumber, that we're gonna, cut down and mill into boards. If we have those, we are gonna have depletion instead of depreciation. So depletion is the expense. And we're gonna reduce our natural resource value by crediting the asset directly. Now, our third type of long-term asset that we're gonna get to after midterm 2 is intangible assets. And so when we kind of divide up the cost of our intangible assets into expenses, we are going to amortize them. So amortize is the same as depreciation, except it applies to intangibles. And we're going to reduce the value of our intangible assets, usually by crediting the intangible asset itself. But sometimes you will see credits to like an accumulated amortization account as well. Now, when we record this expense for depreciation or depletion or amortization, we're going to have a simple debit to our expense, like depreciation expense, and a credit to accumulated depreciation, which will reduce our asset value. So I want to start with a little bit of terminology here, just because there's a lot of new terms. We're going to use them all over the place. So I want to kind of start us off on the same page. So if you remember, the book value of an asset is kind of the historical cost, or what we paid for this thing. So that was the amount we originally capitalized in our PP&E account, minus any accumulated depreciation to date. So that is the book value or the net book value of the asset. Now we also have a useful life, and this is how long we expect the asset to kind of last or continue being useful for producing goods or generating revenues for us. We have a salvage or residual value where kind of once we're done with this asset and we intend to dispose of it, this is what we expect to be able to sell it for. So if you have a truck that you expect to use for 5 years and then you might be able to sell it for $10,000, your salvage value or residual value would be that $10,000. And our depreciable cost is the total amount of depreciation expense, or the total amount of depreciation we're going to take on an asset over its useful life. And it's going to be our historical cost, or what we paid, minus that salvage or residual value. So if we bought our truck for $50,000 and we think we can sell it for $10,000 at the end of its 5-year life, well then we're going to have a depreciable cost or depreciable basis of $40,000. Now we're going to see a handful of different depreciation methods. We've got the straight line method, an activity-based method like a units of production. We're going to do some accelerated depreciation methods like a double declining balance or a sum of the year's digits method. And finally, we're going to talk about the depletion of natural resources in class. By far the most common type of depreciation we see is straight line. It is, the easiest to implement and kind of the easiest to understand. So that's what we see most firms using. We do see a handful using accelerated methods like double declining or sum of the year's digits, and some kind of match their depreciation if they're, they know the machine can produce a certain number of units. They'll use one of those activity-based methods or depletion-based methods. So let's get into how these things actually work, starting with straight line depreciation. So under straight line depreciation, we take the same amount of depreciation expense every single year. And our calculation for what that depreciation expense will be is going to take our historical cost, and we're going to subtract the salvage value. So that's basically our depreciable cost, if you remember from the terminology slide. And we're going to divide that by the useful life in years. And that will give us kind of the annual depreciation expense. And the assumption here is that the machine kind of produces the same amount of revenue every year over its useful life that we're going to use it. So to illustrate this, we're going to use the same example for each depreciation method. Suppose we have the Magic Carpet Company, and on January 1st, 2021, they acquired a delivery truck at a total cost of $15,000. The company estimates that they'll drive this truck for 3 years and then sell it, and they could sell it for about $3,000 when they're done with the thing. And so we're going to first use the straight line method to calculate the annual depreciation expense. So we'll take the cost of $15,000 and we'll subtract the salvage value. So that gives us our depreciable basis of $12,000. And then we'll divide it by the useful life of 3 years and get an annual depreciation expense of $4,000 every single year. Under the units of production method, we're going to assume that the asset is kind of used up at the rate that it is producing units for us. So that might give us the best matching of kind of revenues to expenses. And so what we're going to do here is we're still going to take that depreciable basis, or our cost minus our salvage value, so our total amount that we're going to depreciate. But instead of dividing by the number of years, like we did on the straight line basis, we're going to divide by the estimated number of units that we expect this machine to produce. So that will give us kind of a depreciation expense per unit. And then we're going to measure throughout the year how many units it produces and multiply that by that depreciation expense per unit to get our total annual depreciation expense. So this is going to vary year to year based on how many units the machine produces. Now we have to be careful that we don't depreciate this machine past its salvage value. So once we hit the salvage value, we still stop the depreciation. So if we alter our example here a little bit, we're going to take the same delivery truck that cost us $15,000 and has a salvage value of $3,000, but we're going to say we think we can drive this thing 50,000 miles. So we can find our depreciation expense by first calculating the depreciation expense per mile, which would be our cost of $15,000 minus the salvage of $3,000. The slide has that wrong there. Should be $15,000 minus $3,000 for a net of $12,000 of our depreciable basis. And we're going to divide that then by the total miles we expect to be able to drive this car of 50,000. And so we think this is going to cost us about 24 cents per mile that we drive the car in depreciation. So then when we learn that the car drove 15,000 miles in the current year, we can take that 24 cents a mile, multiply it by the 15,000 miles that we drove, and we get an annual depreciation expense of $3,600 for this first year. Now that amount is going to change every year because the miles we drive each year are going to change. So this is not going to be a constant depreciation expense, but it will be at a constant rate per mile. So the next two depreciation methods that we're going to talk about are what we call accelerated depreciation methods. And the whole idea behind these is that we want to kind of front load our depreciation expenses when we think that the asset is going to be more productive or better at generating revenues. And so if we think the asset will generate high revenues early on in its life, we're going to try to match that up with higher depreciation expenses early on. And at the end of its life, when it generates fewer revenues, we're going to have lower depreciation expenses. Now, both of these next two formulas are completely arbitrary. They're just different ways to kind of accelerate depreciation. And so don't feel like these are kind of the only ways that happens, or there is some important logic that you're missing behind them. They are just formulas designed to kind of give us that pattern of high depreciation expense early and low depreciation expense later on. So the first one I want to talk about is the double declining balance method. And so for this one, our annual depreciation is going to start with the net book value of the asset, the current net book value. So the cost that we paid minus the current accumulated depreciation. And we're going to multiply that by 2 over the useful life of the asset. And that will give us our depreciation expense. Again, this feels like kind of an arbitrary formula, and really it is. And so what's going to change each year is the book value. As we depreciate, the book value is going to fall. And so our depreciation expense each year will fall as well. Now, what we need to be careful about this one is that we do not subtract out the salvage value at the beginning. And so we're just going to stop our depreciation expense once we hit that salvage or residual value. So if we take a look at our kind of example here, we have the Magic Carpet Company again. They have a delivery truck that we bought for $15K and we think we can sell it for $3,000, and we think it has a 3-year useful life. So if we use this double declining balance method, we're going to start in year 1 with the net book value. So when we bought this thing, it cost us $15,000 and we start with 0 accumulated depreciation. So our book value at the start of the asset's life is $15,000. And our depreciation expense is going to take that $15K and multiply it by 2 over the useful life, or 2 over 3. And so our depreciation expense in year 1 is going to be $10,000, or 2/3 of the value of that asset. And so if we record $10,000 of depreciation expense, then our net book value at the end of the year, since we're crediting accumulated depreciation for 10 grand as well, our ending year net book value is going to be $5,000. So then when we start the second year, that $5,000 net book value is kind of our book value that we want to use to calculate our depreciation expense. Again, we want to multiply that by 2 over 3, or 2 over the useful life. And that would give us a depreciation expense of $3,333. Now this would be a problem, because if we recorded that full $3,333 as expense, it would drop our book value below the $3,000 residual value. And we can't go below the residual value of 3 grand because we could think we can sell that thing for $3,000 in cash. And so we're going to cap in our second year here our depreciation expense at $2,000, which will drop us from the $5,000 book value to the $3,000 book value that equals our kind of salvage or residual value. And so kind of more broadly, when you do this, you're going to carry forward the net book value, multiply it by 2 over the useful life. That gives you depreciation expense, but you've got to stop and limit your expense once you hit that salvage value. So then in year 3, we've already hit the salvage value and we have no remaining depreciation expense. So you can see how this really heavily front loads the depreciation expense at the start of the asset's life. Now the sum of the year's digits, again, is another arbitrary formula for kind of accelerating depreciation. What we're going to do in this case is we're going to take the depreciable basis, or the cost minus the salvage value, our total depreciation for the asset, and we're going to multiply that by a given fraction for each year. Now in this case, that depreciable basis, the left side, the historical cost minus salvage, is going to stay the same every single year. What's going to change is the fraction that we're going to use. And our fraction for the year is going to be calculated as the number of years remaining of the asset's life divided by the sum of the year's digits from 1 to the useful life. So if you have a 3-year useful life, our denominator would be 1 plus 2 plus 3. If you have a 5-year useful life, the denominator would be 1 plus 2 plus 3 plus 4 plus 5. And what's going to go on top of this fraction is the number of current years remaining in the useful life. So that numerator is going to change with each year of the asset. And so this is a little bit easier to see with an example. If we go back to our Magic Carpet Company example here, we can see that in the first year, we're going to start with the depreciable basis of 15 grand in cost minus the $3,000 salvage. And then we're going to multiply it by that fraction for our first year. And so the fraction, remember, is the number of years remaining in the numerator. So we've got 3 years left of this truck as of the beginning of the year. And we're going to divide it by the sum of the year's digits, which is taking the useful life and summing from 1 to that useful life. So 1 plus 2 plus 3. And so once you multiply that out, we get a depreciation expense of $6,000 for year 1. If we go to year 2, you can see that the depreciable basis stays the same, $15,000 minus $3,000. The only thing that has changed in this calculation is that numerator. Now we only have 2 years remaining on the useful life of our truck. So we're going to use our fraction as that 2 years remaining divided by the 1 plus 2 plus 3 again. So denominator stays the same. And we get a depreciation expense of $4,000. In the 3rd year, we do the same thing. The only thing in our equation for depreciation expense that changes is the numerator. We've got 1 year left. So we're going to take our $12,000, multiply it by 1 over 1 plus 2 plus 3 to give us final depreciation expense of $2,000. And once you kind of subtract those out, we'll be at a salvage value at the end of its life of the $3,000 that we estimated. So this one automatically takes into account kind of the expected salvage value. And so you can see on this, honestly, slightly confusing graph, I should probably improve this a little bit, but you can see on this graph how our depreciation expense varies from year to year under these different methods, where our kind of blue line here is the straight line method, and our depreciation expense is identical every single year. The purple line is our units of production, and that's just going to vary with how much we, use that machine or use that truck each year. So it's going to jump up and down depending on usage. The light green line is the double declining balance, where it starts really, really high in year 1 and it drops off quite quickly over the course of the asset's life. And then finally, our red line here is the sum of the year's digits. And while the depreciation expense declines every single year, it declines at a constant rate. Like in the last example, we went from $6,000 to $4,000 to $2,000. So we kind of decreased our depreciation expense $2,000 each year. So to summarize depreciation stuff, remember that our goal with depreciation is trying to match our costs to our revenue. So we're just dividing up our cost over the revenue generating periods. And there's lots of different ways to do that. Those ways can be fairly arbitrary, but our goal, if we're being honest, is to try and match up the kind of revenue production with our expenses. Now, we only want to depreciate up to the depreciable cost. If we're doing the straight line method, kind of the units of production or the sum of the year's digits, usually this takes into account the salvage value. So we kind of run the formula that's given on the slide. When we're doing the double declining balance method, however, we have to stop our depreciation once we hit the salvage value. The formula itself won't do it for us. So just kind of something to keep an eye out for. Thanks for watching.